Hi everyone. In this video we're going to go through the comparables model that we have on the Stockcalc website. We use the comparables model to derive a relative valuation for the companies that we're looking at. And what I mean by that is we're actually going to value a company on the basis of other companies that are similar to it to see if it is under or overvalued compared to its peers. So in order to find comparables, it's in the valuation menu on the research page. Simply select comparables. I'm going to run Honeywell, symbol HON. It's a test case. I'll let it load. It takes a second. You can see the current share price, the industry it's in, the industry to compare to. The reason we have both of those there is if you actually want to run it against a different industry, you can do that as well. But we'll leave the diversified industrials as the category that we're going to compare with. There are different criteria that you can actually use to net down the companies that you're looking to compare with, but for now we'll just leave those. If you do add one, you'd select it, add the criteria, and then you can actually adjust the start and end dates as well, and if you want to use the average ratios over that time period or the most recent ratios. So there's quite a bit of flexibility that's built into the model here, but for now we'll just go through with the current industry the company is in. We'll select the end date as of the most recent financials, the month end, and we'll use the most recent ratios. So we'll run this comparable. Now what this does is this actually goes through the database and it selects companies that are similar based on the criteria that we've provided. So in this case it's predominantly the industrials, the diversified industrials category. So what I'm going to do is I'm going to select a few companies from this category. So I'll select ABB, General Electric, 3M, and Rockwell. If you run the value and analyze from the home page, it will do this for you automatically and will look for companies that are similar on the basis of market cap, space that it's in, the industry that it's in, and a number of other factors. So we have those, and we'll actually run those, show the comparables. And what this does is this generates the valuation models based on the comparative data, and you'll see what we have here. So we show the earnings per share, book value, sales, cash flow, and EBITDA per share for the company that we're looking to value, in this case Honeywell, based on the end date values that we have. So the most recent values up to the end date that we selected on the previous tab. You can see a price based on comparables, and I'll come back to that in a second. So here are the ratios for the company that we have. So in this case Honeywell, PE, PV, price to sales, price to cash flow, and EV to EBITDA. Here are the four companies that we selected and their ratio values under these categories as well, and their averages. And what we have here is you take the average value times the most recent to give you a price on a relative or comparative basis. I'll note the EV to EBITDA, if we multiply EV to EBITDA by EBITDA per share, we're actually generating what we call an enterprise value, so we actually have to back the debt out. We do that internally in the calculations. So you can see 1271 times 10 would give us 127, so there's probably about $16 a share in debt for the company, in the case of Honeywell. So Honeywell is trading at $113, and on a relative basis compared to these four companies, it's undervalued. 165, 138, 122, 175, 111. So we're certainly looking at an average here that's comfortably over $130 a share in that ballpark, which would give upside to Honeywell. So in this particular model, being one of the models that you can run, we would show this as an undervalued company. You can see the various ratios and how they've stacked up over time for the companies, which are the solid line, and the comparatives, which are the columns on the charts, to give you an appreciation of what it looks like over the last 5 years. So this is a very nice tool as a secondary to things like the discounted cash flow, if we have the cash flow data available, where we can look at companies to say, on a relative basis, what kind of evaluation would we generate from this. Again, if you go back to the home page and you run the company through Value and Analyze, here you can actually populate all of the models and see everything as well as the report that gets generated from that. So So this is a nice tool to use for any companies that you want to do a relative valuation for.